Welcome back to the NITE Economics YouTube channel, and today we're going to be going over the S&P 500 yet again, and I'm going to be explaining in this video why I think we're more likely going into some kind of a recession, whether it's short-term or long-term, I'm not too sure, but based off of this chart and the current price action of the S&P 500, it's going to give us an idea of where we currently are at in this point in history. So if you've been watching, actually before we get started, again, if you're liking the content, don't forget to subscribe to the channel and drop a like. So now let's get into it. So if you've been watching some of my videos, I've brought up this chart several times. This is the S&P 500 priced in gold, and whenever the S&P 500 drops below this support or resistance level, which is at the 1.44, 1 spot 44, usually it's not a good sign for the S&P 500, right? So like as of pretty much it dropped below this level a couple of weeks ago, and if you could see every time, not every time, but pretty much like about 80% of the times that the S&P 500 drops below this level, this is when it's been in recessions. So let's go back to, let's forget these ones in the early, because it's just, it's too, I don't think it's so important for us. But let's start here. This is the Great Depression. So you could see that the S&P 500 price into gold was well below that support and resistance level back then. And we were in the Great Depression here, and it just kept dropping to gold significantly. There were some big bounces here at the bottom, but it kept dropping to gold overall. Same thing over here in this next recession, right? So it fell off a map, and it was during the period of a recession. This one's a little bit different. It was climbing up. Then during the middle of the recession, there was a pullback, but then the S&P 500 started to climb its way back up. And you could see this pattern kind of repeat itself. You could see here right before or when the recession pretty much started, the S&P 500 started to bleed to gold. Here again, right before the recession, S&P bleeds to gold. Again over here, bleeds to gold, then comes up. And now this is above. This is, so 1, 2, 3, and really this one doesn't count, and 4, or there's only been 4 out of pretty much since the Great Recession. 1, 2, 3, 4, 5, 6, 7, 6, 7, 8, 9, 10. So 10 out of 4 was that? So 10 out of 4, sorry, out of 14 times there's been recessions, 4 of them have been above that support level, and out of the 14 times, 10 of the recessions have been under this resistance level. So what am I trying to say by this? The S&P 500 has now entered below for now. I think it's 4 weeks. It's going on to 4 weeks. Let's see. 1, 2, 3, 4. More than 4 weeks now. Let's zoom in a bit more. 1, 2, 3, 4, 5, 6, 7 weeks. The S&P 500 has been below that support level. But mind you, it's been bleeding significantly. And just because it starts to bleed doesn't mean that a recession is looming. I just think that there's likely, if not a recession, a bigger pullback here in the S&P 500 before it climbs its way back up. So I just wanted to point that out to everybody, that this chart's very interesting, is that most of the times you do have a recession, the S&P 500 is below this 1.44 level. Doesn't mean it can't happen when it's above, but most of the time it does happen in those periods. And also most of the time the recession does happen. Most of the time the S&P 500 is bleeding to gold. All right, so that's the here it's more like in a consolidation. Here it's not really in a bull market there either. Here it drops and then it comes out of it into the long term. But just so you kind of get an idea of what I'm getting at, is that if a recession is going to happen, this might be a likely spot. Not exactly today or tomorrow, but in the next couple of years, maybe we do get one officially announced. So that's just something to keep in the back of your mind, is especially as this chart starts to look like this, it's clearly not a bullish chart for the S&P 500 relative to gold. So something to keep in the back of your mind. And then here also, so now this is the S&P 500, just a regular price, I guess, I suppose. And here you could see that the S&P 500 is definitely starting to break down a bit. And you could see that all the exponential moving averages are starting to really bunch themselves together. It looks like the 21 exponential moving average is going to create a silver cross here and is going to move below the 55 exponential moving average, but we will see on Monday where it opens up to get a better idea if that does happen. If that does happen, I would see some, some realistic targets down to like around this 200 simple moving average, which is currently sitting around $6,600. But I wouldn't be surprised if we just revisit these lows from November, right? So from pretty much the end of November, these lows. And if things do get really bad in the, I would say in the medium term, maybe we get down closer to these levels here. Maybe even if things get really bad, it could get down here. But again, let's not get ahead of ourselves. I'm looking more for this low from November to be retested first, and so essentially reconnecting with this 200-day simple moving average if this silver cross is confirmed on Monday, which I think it likely will be confirmed, but we will see, because many times it looks like it's gonna happen. Well, actually, I mean, we haven't had it happen in a while. Actually, it hasn't happened since back here, and then that, so yeah, I guess if it were to happen, maybe some realistic targets could be closer to maybe even this 377 and maybe even below, but we will see. Let's not get ahead of ourselves. Let's look at the weekly. Yeah, so I'm just expecting a target down here at revisiting the lows of November. So that's kind of that's sitting right now at 6,500, 6,600 bucks. And yeah, if things get a little bit crazier, then maybe we revisit down here at on the weekly, the 55 exponential moving average, somewhere in between here, 6,400 to 6,500 bucks, somewhere around this pocket, touching this exponential moving average. And then we just take it one step at a time. I think if something like this were to happen, and we were to revisit, I'm not saying this is going to happen, to be clear, but if we were to revisit this, I think this would be the catalyst to make the Federal Reserve step in and start money printing, because that would be a massive drop, right? So from current highs all the way down there, whoops, it's about a 30% drop. Let me do that again. Yeah, so it's a 30% drop from current highs. I'm not saying that's gonna happen. Again, we're taking this one step at a time. First, we're gonna look at if the S&P 500 gets down to the November lows, which it's about 6%, 6-7% from current, not from current, from all-time high. From current levels, it's not that far. So maybe it just gets down there and works its way back up. Right, so that's 3.5%. So it's not a giant move, but for traditional markets, it is quite a large move. And maybe it does something like this, right? So you see here, last year, it started topping out, came down, got down to this region, then came back up, created a higher high, then it toppled over. So maybe something similar to that can happen, or maybe it does something like this and it continues to run for, several weeks more, right? So I think, either we're gonna get something like this, or into the next year or two, we could get something like this at some point. You're gonna reconnect to this 200-day simple moving average, but it could be maybe some time out into the future where the S&P 500 is a lot higher, gets up into the 7,000 price mark, and then it reconnects with that 200-day simple moving average. But we will see, right? As of right now, I'm looking at just targets to reconnect or revisit the previous lows, and those were set in November, and it's around 6,500 bucks. That's all I have for today. If you're liking the content, please subscribe to the channel, drop a like, and I'll see you guys next time, and have a great weekend. Take care.